Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial mumbo jumbo. And let me tell you, Holley Inc. has filed a report that's got signals flashing red and green all at once. Get ready because we're diving deep into Holley's latest quarterly report. Sales are down a bit, but hey, their profits are actually looking up in some areas. It's a mixed bag, and we're going to break down exactly what it all means for you. And if you appreciate getting straight insights from complex corporate filings like this, smash that subscribe button. We also have a fantastic community Discord channel linked in the description below where you can chat more about these kinds of reports. Alright, let's get straight into the guts of this Holley Inc. filing. It's their quarterly report covering the period up to June 29th, 2025. Think of this as a quick checkup on the company's health, how they did in the last 3 and 6 months. Looking at the big picture, Holley has about $1.16 billion in total assets, which is a bit more than they had at the end of last year. Their cash on hand jumped up to over $63 million, which is always a good sign, giving them some breathing room. Their current assets, the stuff they can turn into cash pretty quickly, are sitting at a little over $303 million. That's up slightly from last year. Now here's an interesting one. Goodwill, essentially the premium they paid for past acquisitions, is a hefty $372 million. This number hasn't budged, which means no new big deals or write-downs on old ones. And then there are these other intangible assets like brand names and licensees totaling over $403 million. They actually increased this quite a bit, which seems to be related to a new license agreement they picked up. We'll talk more about that later. On the other side of the coin, their total liabilities are around $720 million. Their debt levels are still pretty high, over $543 million, though it's slightly down from the end of last year. Stockholders' equity, the owner's stake in the company, stands at a solid $437 million. Now let's get to the nitty-gritty, the income statement. For the 3 months ending June 29th, 2025, Holley's net sales were about $166.7 million. That's a small drop, just under 2% compared to the same time last year. This decrease in net sales is pretty straightforward. They say it's due to lower sales volume, even though they managed to get a bit more money per sale. Think of it like selling a few fewer cars, but charging a little more for each one. Interestingly, their cost of goods sold, the direct cost to make their products, went down too by almost 2%. This is a bright spot. They attribute this to lower shipping costs, which is part of their plan to save money. Because their costs went down a bit more than their sales, their gross profit actually stayed pretty much the same, around $69.6 million. Their gross margin, which is how much they make on each dollar of sales after paying for the product itself, edged up slightly to 41.7%. They say this is because they had some big sales clearance last year that they didn't repeat this year. Selling, general and administrative costs, the everyday running costs of the business, went down by almost 5%. This is a good trend, and it looks like they're getting more efficient here. But check this out. Their spending on research and development, the engine for future products, actually went up by a pretty significant 18%. They mentioned reassigning some employees from sales and admin to R&D, so they're shifting their focus to innovation. All of this put together means their operating income, which is their profit from core business operations, was pretty much flat at around $27.55 million. Now, these next few items are a bit more on the accounting side, but they're important. They had a gain from changes in the value of their warrants, which are like options to buy their stock. It's a small gain this quarter. And a similar small gain from their earn-out liability, which is basically an estimated future payment tied to certain performance goals. These can swing up and down quite a bit. Their interest expense, the cost of their borrowing, stayed pretty stable at around $13.4 million. They mention here that their interest rate collar, a way to manage interest rate risk, actually had a negative impact this quarter. So when you put it all together, their income before taxes took a hit, falling by a quarter compared to last year, down to about $14.4 million. And their income tax expense went up quite a bit, almost 71%. This, along with the other factors, led to net income for the quarter dropping by a significant 36.5% to about $10.9 million. Now let's zoom out and look at the first 6 months of the year. This is where things get a bit more interesting. Their net sales for the first half of 2025 were down 2.6% to roughly $319.7 million. It's a similar story to the quarter, lower sales volume offset by better pricing. But hold on, their cost of goods sold dropped by almost 10%. This is a big deal. They attribute a good chunk of this to a product rationalization initiative last year, where they got rid of less profitable products, plus those lower freight costs are helping too. Because their costs came down so much more than their sales, their gross profit actually jumped up by over 9%, reaching about 133.6 million. This made their gross margin much healthier, climbing from 37.3% to over 41.8%. This is a significant improvement in their core profitability. However, those selling, general and administrative costs increased by about 3%. They say this is mainly due to high legal fees, including some settlement costs, which ate into some of the improvements in their core operations. R&D costs stayed pretty much flat. Restructuring costs went up a bit, reflecting ongoing efforts to streamline operations. So despite the drop in sales, that big reduction in cost of goods sold really boosted their operating income. It jumped by a healthy 23% to about $46.9 million. This is the real takeaway here. They're becoming more efficient in their production. Again, we see gains from the changing values of their warrants and earn-out liabilities. These are accounting adjustments not directly related to their day-to-day business operations. Interest expense, however, increased significantly by over 20%. This is partly due to the negative impact of that interest rate collar we mentioned, but also likely due to the overall higher interest rate environment. With higher interest costs and an increase in income tax expense, their income before taxes actually fell by 17%, landing at around $18.3 million. And this brings their net income down to about $13.7 million for the first half of the year, a drop of over 34% from last year. Now, Holley also likes to talk about adjusted EBITDA, which is a way to look at their performance without some of these accounting adjustments and one-time costs. For the first 6 months, their adjusted EBITDA was about $63.7 million, which is up from $59.3 million last year. This confirms that despite lower sales, their core business operations, before some of these other factors, are actually performing quite well thanks to those cost savings. And what about cash flow? Free cash flow, which is the cash left over after they've invested in their business, was about $24.8 million for the first 6 months of 2025, down from about $42 million last year. This drop is mainly because they spent more on investments, including that new license agreement we talked about earlier. Looking at their liquidity, Holley has about $63.8 million in cash and almost $97.4 million available under their credit line. They seem to have enough money to keep things going and pay their bills. They do deal with some foreign currency fluctuations, but it seems to have been a minor impact so far. The cash they generated from their actual operations, their operating cash flow, was about $32.6 million for the first 6 months. That's lower than last year, mainly due to some changes in how they manage their short-term assets and debts like accounts receivable and payables. Their investing activities used up about $20.9 million, largely due to that purchase of the Cataclen license. This is a strategic move to expand their product line. And financing activities used about $4.5 million, mostly for paying back some of their debt. They also touch upon exchange rate sensitivity. While most of their business is in US dollars, they do have some exposure to currencies like the euro and Canadian dollar. They aren't hedging this exposure right now, but they're keeping an eye on it. Something important to note, and this is a recurring theme for Holley, is their disclosure controls and procedures. They state that their disclosure controls were not effective. This is due to a previously identified material weakness in their internal financial reporting. They're working on fixing it by hiring more accountants and bringing in outside experts, but it's an ongoing process. This might raise a small flag for investors looking for super tight financial controls. And there's some ongoing legal action. A securities class action lawsuit has been filed with the plaintiffs alleging that the company made misleading statements about its business. Holley is fighting these claims, but it's something to keep an eye on as these sort of lawsuits can be costly and distracting. So what's my take on all this? Holley is a company in transition. Their core operations, the actual making and selling of car parts, seem to be getting more efficient. That jump in gross margin driven by cost cuts and getting rid of less profitable products is a big positive. It shows they can become leaner and more profitable even with slightly lower sales. That increased operating income, despite lower revenue, is a testament to better cost management. To a coffin net income isn't ideal. and the increased interest expense is a concern, especially in this high interest rate environment. Plus the ongoing legal issues and the not yet remediated internal control weaknesses are definitely points of caution for any investor. They're making smart moves like acquiring that Cataclean license, which shows they're thinking about growth, but they need to get their financial housekeeping in order and resolve those legal challenges. It's a bit like a sports car that's getting a better engine tune-up, but still has some dashboard warning lights on. They're heading in a generally positive direction operationally, but there are still some fundamental issues they need to address to really hit their stride. Alright, that's our breakdown of Holley's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.